At the same strike price, a cash-secured put and a covered call have the exact same profit and loss profile, yet most traders treat them like complete opposites. Many traders view selling puts and selling covered calls as two distinct strategies. In reality, they are synthetically equivalent positions that generate income through time decay. The choice between them depends primarily on your current asset allocation rather than a difference in market mechanics. Let's define the cash-secured put, or CSP, first. You sell a put option and set aside enough cash to buy 100 shares if the stock price drops below your strike. This strategy is bullish to neutral, as you profit if the stock stays flat or rises. Psychologically, the CSP is often used to enter a stock position at a discount. You are essentially saying, I am willing to buy this stock at price X, and I want to get paid for waiting. If the stock never drops to your price, you keep the premium as pure profit. Conversely, a covered call involves selling a call option against 100 shares you already own. You collect a premium in exchange for capping your upside potential at the strike price. Like the CSP, this is a bullish to neutral strategy that benefits from time decay. The covered call is typically viewed as a way to generate rent on shares you intend to hold long-term. However, it changes the trade's nature by limiting your participation in a massive rally. You are trading potential moonshot gains for guaranteed immediate cash flow. Here is the critical concept of put-call parity. A covered call, long stock plus short call, has the same risk profile as a cash-secured put, short put plus cash collateral. At the same strike price, their profit and loss curves are mathematically identical. If the math is the same, why choose one over the other? The decision starts with your current portfolio composition. If you are sitting on cash, selling a put is more capital efficient than buying stock and immediately selling a call. Buying stock just to write a call requires 2 commission events and paying the bid-ask spread twice. Selling a cash-secured put requires only 1 transaction to establish the same bullish exposure. This efficiency makes the put preferable for initiating new positions. However, tax implications create a major divergence between the two. If you have held a stock for a long time, selling it to switch to a short put strategy would trigger a taxable capital gains event. In this case, sticking with the covered call is usually superior to preserve tax deferral. Let's look at the break-even points to see how they protect you. In both strategies, the premium received lowers your effective purchase price or cost basis. This provides a buffer against minor market downturns that a simple buy-and-hold investor does not have. The risk profile for both is nearly identical on the downside. If the stock crashes to zero, a covered call writer loses the share value minus the premium. A put seller is obligated to buy worthless shares at the strike price, losing the cash collateral minus the premium. Upside risk is where the emotional experience differs significantly. If the stock rallies, the put seller keeps the full premium and feels successful. The covered call writer also keeps the premium but may feel regret as their shares get called away, missing out on further gains. This brings us to the wheel strategy, which cycles between these two options. You start by selling puts until you get assigned the shares. Once you own the shares, you flip to selling covered calls until the shares are called away. The wheel allows you to collect premium at every stage of the trade cycle. It effectively automates the process of buying low and selling high, provided the underlying stock does not enter a permanent secular decline. Implied volatility, or IV, is the fuel that powers the premiums for both strategies. When IV is high, premiums are expensive, favoring sellers. You should look to enter these strategies when IV rank is above 50 to maximize your income potential. However, chasing high IV can be a trap if the underlying company is fundamentally broken. A common mistake is selling puts on meme stocks solely for the juicy premiums. Remember, if the stock goes to zero, the premium will not cover your capital losses. Another critical mistake is selling covered calls below your cost basis. If you bought a stock at $100 and it drops to $80, selling a $90 call locks in a guaranteed loss if you are assigned. In recovery scenarios, it is often better to wait or sell very low delta calls. When managing these trades, rolling is a defensive mechanic you must understand. If a trade moves against you, you can buy back your option and sell a new one for a later date and potentially a different strike. This buys you time for the trade to recover. Usually, you only want to roll for a net credit, meaning you collect more money for the new position than you paid to close the old one. If you have to pay a debit to roll, you are often just digging a deeper hole and increasing your capital risk. Dividends also play a role in your decision. If you sell a put, you do not own the shares and do not collect dividends. If you own the stock for a covered call, you capture the dividend, but you must be aware of early assignment risk before the ex-dividend date. Ultimately, do not view these as separate strategies, but as different tools for different states of share ownership. Use the put to acquire shares and the call to release them. This mindset shifts your focus from gambling on direction to managing inventory. Here is the final decision framework. If you have cash and want to buy, sell puts. If you have shares and are neutral bullish, sell calls. Avoid selling calls on stocks you expect to moon, and avoid selling puts on stocks you wouldn't want to own for 5 years. Choose your entry based on asset allocation, not just premium.